Imagine trying to push like the entire Library of Congress through a standard garden hose.
Yeah, that's a mess.
Right. And doing it in a fraction of a second, because that is essentially what artificial intelligence companies are trying to do right now with their data.
It's a massive bottleneck.
It really is. And today, we are looking at a massive stack of financial reports, insider trading filings, and market data for the one company that basically figured out how to build a bigger hose.
The essential plumbing, yeah.
Exactly. We are diving into the explosive behind-the-scenes world of AI infrastructure, specifically through the lens of a really fascinating company called Lumentum.
I mean, it's really the perfect lens for understanding this exact moment in tech history.
For sure.
Because building the invisible infrastructure of the AI revolution isn't just an engineering marvel, you know. It's a financial phenomenon.
Right.
If you want to understand how a single business can achieve a staggering 641.85% return over a single 52-week period, this is the story you need to unpack.
Wait, over 640% in a year? That number alone just forces you to stop and pay attention.
Hard to ignore, yeah.
But, you know, the mission for today's deep dive isn't just to gawk at a historical stock chart. We are trying to understand a very specific, a very strange tension.
The recent pullback.
Yeah, because despite that massive historic run-up, Lumentum stock has recently hit a pretty hard wall. It is currently sitting at a 34.4% drop from its recent peak.
Which creates a massive puzzle for anyone looking at this space.
Definitely.
Because you have these unbelievable secular tailwinds, meaning, long-term structural shifts in the economy, driven by the biggest tech companies in the world just pouring billions into data centers.
Right, the hyperscaler.
Exactly. But you also have the reality of market gravity and sudden price pullbacks. So figuring out the space between that incredible fundamental demand and the current 34% drop is the core of what we need to figure out for you today.
I want to start by looking under the hood of the business itself, though. Because, I mean, a stock doesn't hit a $54.79 billion market cap and jump 640% on good vibes alone.
No, you need real numbers for that.
Right. And looking at the fundamental data in these reports, we are seeing a trailing 12-month revenue growth of 68.98%.
Which is massive at that scale.
It's huge.
Yeah.
So what is actually driving that kind of explosive acceleration?
Well, that revenue explosion is the direct result of massive demand for two things. Basically, datacom transceivers and cloud AI infrastructure.
Okay, so datacom transceivers.
Yeah. To translate that out of tech speak, think about the companies we call hyperscalers. These are the massive cloud providers. Alphabet, Microsoft, Amazon.
Go big guys.
Right. And Alphabet recently announced they're drastically raising their capital expenditure forecast for AI.
So they're spending even more.
Way more.
Yeah.
And when a giant like Google decides to spend billions more on data centers, a huge chunk of that cash flows directly downstream to companies like Lumentum.
Because they make the parts.
Exactly. Yeah. They manufacture the physical components needed to actually build those networks.
Okay, so let's unpack those components. A transceiver. For those of you listening who haven't spent your morning, casually reading data center schematic.
Which I'm sure is everyone.
Right, exactly. A transceiver is essentially the device that translates electronic signals into light signals and vice versa. But why is that specific piece of hardware suddenly the massive bottleneck for the entire AI industry?
It really comes down to the fundamental limits of physics.
Physics?
Yeah. Normally, computers talk to each other using electricity over copper wires. And that works fine for everyday computing.
We're sending an email.
Right. But AI, specifically the large language models everyone is racing to build right now, it requires thousands of servers to talk to each other simultaneously just to process mountains of data.
That's constant communication.
Nonstop. And if you try to push that much information through copper wires, the electricity generates way too much heat, and the data just moves too slowly. You create a massive traffic jam.
And heat in a data center is like the ultimate enemy. It melts hardware. It costs a fortune in cooling.
Exactly. So the solution is LITE. Lumentum's transceivers literally translate those electronic thoughts from the server into photons, particles of light, and shoot them across fiber optic cables.
Oh, wow.
Yeah, the speed of light is the only thing fast enough to handle that level of communication without generating massive heat and creating that bottleneck.
Okay, so I have to push back here for a second. We have seen this movie so many times in the tech sector, right?
Oh, absolutely.
A company makes a great gadget that solves a current problem. They get a massive temporary bump in sales, and then a bigger tech giant just swoops in, reverse engineers it, and steals their lunch.
A tale as old as time.
Or, a dozen cheaper competitors flood the market and drive the price down to zero. So how is Lumentum actually turning this temporary AI rush into a sustainable, defensible business?
Well, the defense against that exact scenario is what we call an economic moat. And Lumentum's moat is built on incredibly deep intellectual property in a field called photonics.
Photonics, the light stuff.
Right, the science of generating and manipulating those light particles. Yeah. Creating lasers that can reliably translate data at the speed of light, run 24/7 in a hot data center, not overheat, and never degrade the signal. I mean, that is highly advanced physics.
So it's not just something you can easily copy.
Not at all. The technological barrier to entry is absurdly high. It's not just snapping together plastic parts in a factory.
Yeah, that makes sense.
And think about it from the perspective of the customer, right? If you are Alphabet and you are spending tens of billions of dollars to build a state-of-the-art AI data center.
You want the best parts.
Exactly. You are not going to risk the entire operation crashing just to save a few bucks on a cheaper, unproven optical component from some knockoff competitor.
That would be a disaster.
$1 billion disaster. The switching costs, like the logistical nightmare of replacing this fundamental infrastructure once it's already installed, are massive.
So once they're in, they're in.
Once Lumentum is designed into a hyperscaler's architecture, they are effectively locked in.
And looking at the financial data here, you can actually see the proof of that lock-in.
The margins, right?
Yeah, because if Lumentum was just fighting on price with a bunch of competitors, their profit margins would be razor thin. But their gross margin over the last 12 months is sitting at 37.71%.
That's a huge premium.
It is. Their net margin is 17.68%, pulling in an earnings per share of $5.41. That tells me they have serious pricing power. They aren't discounting their tech just to win contracts.
No, not at all. Those margins demonstrate immense operational leverage. As they scale up production to meet this massive AI demand, their profitability expands rapidly.
Which means more cash.
Exactly. It means they are generating a massive amount of cash, which they can then funnel right back into research and development to stay ahead of whatever competitor might be trying to catch up.
The industry itself is backing that up too. In the notes here, it shows Lumentum's CEO, Michael Hurlston, was just awarded the 2026 Optica i4 Individual Achievement Prize.
That is actually a really big deal. When the broader scientific and engineering community formalizes their recognition like that, it's a massive signal.
It's not just an industry participation trophy.
No, it cements their position not just as a vendor selling parts, but as the company defining the technological edge of the entire global optics industry.
Okay, so let's look at the picture we've just painted here for you. The underlying technology is basically magic. The biggest tech giants on Earth are completely dependent on them. They have a massive protective moat, and they are printing cash with nearly 38% gross margins.
Sounds pretty good.
Right. If I look at that logically, the stock should be an absolute rocket ship right now, but it's not. The ticker is painting a very different picture. So why is the market punishing a company that seems to be doing everything right?
Well, that tension between a dominant business and a struggling stock price requires us to pivot a bit. We have to look away from the fundamentals and focus on the technical reality of the market, because the whiplash here is severe.
Severe is putting it lightly, yeah. For those of you tracking the actual price action, Lumentum is trading around $711.96 today.
Down pretty hard.
Yeah, that is down nearly 6.7% just in a single trading session. But the bigger shock is that 34.4% drop we mentioned at the start.
Right, from the high.
Back in May of 2026, this stock hit an all-time high of $1,085.68.
And now it's in the sevens.
Yeah. And the 52-week range is incredibly volatile, swinging from basically $101 all the way up to almost $10.86.
So when you see a 13-week return sitting at a negative 12.66%, the initial instinct is that the sky is falling.
Like something is fundamentally broken at the company.
Exactly. But context and market analysis is everything. Even after taking a 34% haircut from that peak, if you zoom out, the stock is still up 107% year to date.
Up 107%. So how should a rational observer interpret a 34% drop if the underlying business is still sound?
You look at the volume.
Volume?
Yeah, the volume regime is a metric that compares the current trading activity to historical averages. Right now, Lumentum's volume regime is sitting at 0.69x,
Meaning what exactly?
meaning trading volume is significantly lower than normal. In technical analysis, a sharp drop on low volume suggests a healthy higher low is forming after an extended parabolic run.
A healthy drop. Let me see if I can translate that. Imagine you just sprinted a sub-10-second 100-meter dash.
Okay.
You crossed the finish line, you broke the world record. You are not going to immediately turn around and run another one.
No, you'd collapse.
Right. You have to stop, put your hands on your knees, and catch your breath. So the fact that the stock is pulling back on low volume is like the runner resting.
That's a great analogy, actually.
It's not a crowd of people panicking and fleeing for the exits. It's just a lack of aggressive new buyers combined with some natural profit-taking.
The low volume drift during a pullback is classic consolidation. If this were a panic, what we call distribution in the market, you would see massive red volume spikes as institutional players aggressively dumped millions of shares.
But we aren't seeing that here.
We aren't seeing that at all. Often, this kind of quiet consolidation precedes a volatility breakout to the upside. It's just the market digesting that massive 640% run before deciding on its next move.
But if I really want to know if a pullback is just the stock catching its breath or if it's a warning sign of a deeper sickness, I look at the insider.
They're executives.
Right. What are the executives and board members doing with their own personal wallets? And this brings us to one of the most fascinating contradictions in this entire stack of data.
Oh, the insider flow data on Lumentum right now definitely requires some serious unpacking to understand.
Because on paper, the filings show that insiders have technically been net sellers. Over the tracked period, executives dumped over 57,000 shares.
Which sounds bad.
It sounds terrible. If I'm looking at a stock that is down 34%, and I see the people running the company unloading 57,000 shares, my first instinct is to just run the other way.
Head for the hills.
Exactly. Yet, the data we are looking at gives Lumentum an insider sentiment score of 100, a perfect 100 out of 100, which is flagged as strongly positive. How on earth is net selling considered a wildly bullish signal?
It feels completely backward until you look at the actual mechanics of corporate compensation. You have to separate routine mandatory selling from high conviction buying.
Okay, break that down.
So the net share count often goes down simply because executives receive a massive portion of their salary in restricted stock units, or RSUs.
Right, stock instead of cash.
Yeah. And when those stocks finally vest and become theirs, the IRS wants it cut immediately.
Taxes.
Always taxes. The executives are often forced to automatically sell a large chunk of those newly vested shares just to cover the tax bill. Or, they have pre-planned blind schedules to diversify their portfolios so they don't have all their eggs in one basket.
So those 57,000 shares being sold, that's just financial housekeeping.
Exactly.
It doesn't mean the CEO thinks the company is doomed. It just means it's tax season.
It tells you almost nothing about their actual belief in the company's trajectory. What the insider sentiment score of 100 is actually picking up on is the other side of the equation, a phenomenon called cluster buying.
Cluster buying.
Yeah. This is when multiple different insiders, say the CFO, a board member, and the head of engineering, they all independently decide to take their own after-tax cash and buy shares of their company on the open market at roughly the same time.
With their own money.
Yes. Even if the total number of shares they buy is smaller than the amount sold for taxes, the predictive nature of cluster buying is a massive tell. It shows incredibly high bullish conviction.
Wow, okay.
These are the people who see the internal order books, they know what the next product pipeline looks like, and they're using their own money to buy the dip.
So they're looking at that 34% drop and seeing a discount, not disaster.
That's the signal, yeah.
And that ties directly into another dynamic bubbling beneath the surface in these reports. Squeeze speculation.
Yeah, the data is flagging squeeze watch symptoms building up. You have strong underlying fundamentals. You have analysts issuing rating upgrades because the earnings growth is just undeniable. And you have this high insider conviction.
It's all lining up.
Right. When a stock pulls back and consolidates quietly while all these positive pressures build underneath it, you create a very tightly coiled spring. Speculators notice that tension, and unconfirmed bullish pressure starts mounting.
Okay, we've talked about the perfect insider scores, the impenetrable photonics moat, and the massive alphabet spending tailwind. But, no deep dive is complete without looking at the dark side.
Got to look at the risks.
What are the actual tangible risks here? Because there is always a bear case, and I want to know what it is before we crown them the undisputed king of AI.
The bear case here is completely valid, actually, and it has nothing to do with their technology. It is entirely centered on their valuation,
And numbers.
the staggering expectations that are currently baked into their stock price.
Let's talk about those expectations, because looking at the valuation multiples here is, well, it's terrifying. We are looking at a price-to-earnings ratio, the PE of 124.56.
That is steep.
And a price-to-sales ratio of 22.02.
Those numbers represent a massive, massive premium.
Just to put that PE of 124 into perspective for you listening, that means investors are willing to pay $124 today for just a single dollar of the company's current yearly profit.
It's a lot of faith.
Imagine your local coffee shop makes $10,000 in profit a year. A PE of 124 means you would buy that coffee shop for $1.2 million.
You'd have to be crazy.
You would only pay that absurd price if you believed that coffee shop was about to turn into the next Starbucks and multiply its profits instantly. Lumentum is basically priced for absolute, flawless perfection. What happens if Alphabet or Microsoft suddenly decides they've built enough AI servers for the next couple of years?
You've just identified the single greatest vulnerabilities for Lumentum, and really for any company trading at these nosebleed multiples. It's a mechanism called multiple compression.
Wait, so when you say multiple compression, you're saying the underlying math simply catches up to them?
Sort of, yeah.
Like, even if they continue to hit their sales goals and remain highly profitable, if the broader market suddenly decides AI isn't growing at 1,000% anymore, the hype deflates and the stock crashes anyway.
That is exactly how it works. A PE of 124 implies the market demands exponential, uninterrupted growth. But if the macro trend of AI infrastructure spending slows down even slightly,
Which it could.
right, if these hyperscalers decide to just optimize the data centers they already have rather than building new ones, Lumentum's revenue growth will decelerate.
And when growth decelerates, investors refuse to pay 124 times earnings.
Exactly. They might decide a more reasonable price is, say, 40 times earnings. If that multiple compresses from 124 down to 40, the stock price absolutely craters, even though the underlying business is technically fine and still making money.
That's brutal.
At these premium valuations, the stock is completely unforgiving. That 13-week bearish momentum we talked about, the quiet consolidation. If they miss an earnings expectation, that consolidation turns into a violent, aggressive correction instantly.
The classic risk of flying too high.
Absolutely.
So let's bring all these threads together for you listening. The core tension we've unpacked today is really a masterclass in the clash between business dominance and market valuation.
It's a textbook case.
On one side, you have Lumentum riding an unbelievable structural wave. They are armed with a deep technological moat in photonics. They have insiders quietly buying up shares with their own cash, and they are serving as the critical, irreplaceable infrastructure for the global AI build-out.
It's what fueled that historic 640% run.
Right. But on the other side of that scale, you have the terrifying reality of a 124x PE ratio. You have a stock that has already pulled back 34% from its highs, forcing anyone watching the space to wonder if the easy money has already been made.
And questioning if the hyperscaler spending spree can actually sustain this valuation long term.
So if you're tracking this tension, what is the immediate horizon? What is the next catalyst that will tip the scales one way or the other?
Well, the most immediate event on the catalyst calendar is Lumentum's next earnings report, which is likely hitting in late August or early September.
Okay, so coming up soon.
Yeah, and that report is going to be their real moment of truth.
Right.
Because consensus expectations are already adjusting higher based on the known AI demand. Lumentum doesn't just need to report a good quarter.
They need to blow it out of the water.
They need to report undeniably phenomenal numbers to justify and defend that 124x multiple. Beyond that, you should keep an eye on upcoming industry conferences, Watch to see if management, led by their award-winning CEO, outlines new capacity expansions or product roadmaps that prove this growth can extend years into the future.
It's going to be an incredibly high-stakes few months for them.
Without a doubt.
But I want to leave you with one final provocative thought today, something that wasn't explicitly covered in the financial data we reviewed, but builds directly on this entire infrastructure tension.
Okay, let's hear it.
So we've established that Lumentum is thriving specifically because tech giants are building massive, centralized, hyperscale data centers.
The giant hubs processing everything.
Right. But technology never stands still, you know? As AI models become more refined, highly specialized, and dramatically more efficient, there is a growing argument in the tech world that the massive spending could eventually shift away from those giant centralized hubs.
To the edge.
Exactly. What happens if the industry pivots towards smaller, localized edge computing? Think about highly capable AI running natively right on your smartphone or within small local enterprise servers that don't need to constantly ping a massive server farm hundreds of miles away.
It changes the whole game.
If the fundamental architecture of how AI operates changes, do we still need the massive, centralized fiber optic plumbing Lumentum provides?
Man, it is the ultimate existential question for any infrastructure play. The gold rush of AI might continue for decades, but the miners might decide they need a completely different set of tools.
Exactly.
If the processing moves to the edge, the demand for centralized data center transceivers changes completely.
Just because you built the most advanced hose today doesn't mean anyone is going to be pumping data through it tomorrow. It's a fascinating risk to weigh against their current dominance. Keep an eye on those profit margins, watch the volume on this pullback, and we will see you on the next deep dive.